Hello everyone, myself Deepak Gupta and we will take up a topic risk and return session 2. In the earlier session, we primarily discussed about how the fluctuation in the returns of the security justifies the risk, and we underlined the difference between the risk and the uncertainty. That is, the uncertainty was not measurable but the risk is measurable, so we can always say the risk is a measurable uncertainty, and we tried to relate the risk with the return along with understanding how to calculate the holding period return. And based on these two parameters of risk and return, we tried that there may has to be a decision regarding the choice of the security. So we can always make a choice between two mutually exclusive investment options, or we can always create a mix of securities, and that mix of securities will justify the word portfolio. So we will focus more on the portfolio selection in the later stages of our this chapter series. So today we will try to measure the risk with in the frame of probability, and based on that we will move on to calculate the figure of standard deviation, which normally is a measure of the security. So probability, as you all understand, that this denotes a chance of the uncertainty, the chance negatively or positively, that is what you anticipate. मैं क्या बोल रहा हूँ, मैं इसको पहले एक एग्जाम्पल के साथ लेकर आता हूँ कि अगर हमने एक सिक्योरिटी एक्स चूज करी एंड द करंट प्राइस ऑफ द सिक्योरिटी इज लेट्स से ₹10. So what we anticipate by investing ₹10 in the security is either the dividend or the increase in the price of the share. So if we're taking the 1 year horizon, so we are anticipating what is the expected dividend and what is the expected price, because this D1 plus the capital gains of P1 minus P0, that is the capital gains, they will denote the total returns on the security as discussed in the first session. And those total returns, if divided by the investment, that is P0, will give you the figure of HPR. So concept is, what is HPR already discussed, but what is the probability of generating the HPR that prompts you to make an investment decision? मीन्स अगर आपने कहा कि आपका HPR 14% है, तो आर यू 100% श्योर? So if you are 100% sure, then it is a denoting 100% probability, and that is the risk looks to be nil. Or vice versa, that if you are anticipating that this 14% can be 80% chance of generation, then what are the remaining 20% chances of generation? And if you believe that it could not be 14 but 12%, so now there are two figures with different probabilities. So if we denote this probability by P1 and this as P2 and this return as R and R1 and R2, so we can say that the expected returns should be the multiplication of probability with the return and their weighted average as calculated. So 80% with the 14% return probability plus 12% return with the 20% probability. So if you will see here that this will come out to be 0.0112. I think it will be point, not the zero here. So it will be, because there should not be any mistake, this 0.14. So this will be 0.112 plus 0.024, because 0.12 multiplied by 20% will denote 0.024 plus 0.112. So this is coming out to be 0.136. So this basically denotes a expected return after covering for the probability. So we can say that you anticipate 14%, but you may get 13.6%. That is, you may receive less, and it's a 80% chance of this. Or you anticipate 12% and you can get 13.6%, and there is a 20% chance of it. So, what you anticipate and what you get. So, there is a reduction in your anticipated returns, and there is quite a high probability for it, that is 80%. And if you anticipate 12% and you get 13.6%, so though you will get more once you are expecting, but there are very less probability of doing that. So the concept is justified in this way, that this risk fluctuation along with the probability calculation will denote the concept of risk, and that will be measured through standard deviation. And that will be measured through standard deviation. So we will first try that how I arrived at this figure of 14% with 80% probability and 12% with 20% ability. And also, it is not possible, or it may not be possible, that there are only two expected returns, because different people may expect different returns, or there may be different ways of calculating the expected returns, and they may have different probability or expecting percentages. So if I go into that detail, so if I believe that a current market price of rupees 10 is expected to give a dividend of say rupees 2, and the price after 1 year is expected to be 12.4, is expected to be 12.4, and there is a probability of only 20% of achieving this. So here the return, that is the HPR, as calculated with the above formula, will be 2 plus 12.4 minus 10 divided by 10, and I'm showing it again. I will not show in the next point, because they will be recurring and you will be understanding by this one figure again. So this will be 2 plus 2.4 upon 10, so it will be 4.4 upon 10, and it will justify a return of 44%. Now that is a huge expected return. But this can be the scenario 1. Now if I go to the scenario 2, where you see that current market price will only get a dividend of rupees 50 paise, and the price that is expected is only 10.9. So then probability of getting it is 10%. So here the HPR will be 0.50 plus 0.9 upon 10. So this will come out to be 1.4 upon 10, and that will come out to be 14%. So if I take the third example and we presume that this is your best chance, so this is the best scenario, and this is your worst chance, that this is your worst scenario. So in both the cases, now if we go to a third scenario where the current price of 10 is expected to give a dividend of 75 paise, with the expected price of 11 and the probability of achieving this is 25%. So what we are getting 0.75 plus rupee 1 upon 10. So this will come out to be 17.5%. Similarly, if we take another mid scenario where the price of rupees 10 is expected to give a dividend of rupees 2.5, but the market price is going to reduce to 9.5 and there is 15% probability of it. So this will come out to be 2.5 plus minus 0.5 upon 10. So this will give a return of 20%. And if I take the last scenario, because these probabilities have totaled to 70%, so if I close this to a 100% probability scenario with 30% chance of the fifth scenario, where the price of rupees 10 is expected to give a dividend of rupees 16 and the price expected after first year is 11.10, so the return will be 60 paise plus 1.1 upon 10, so the returns are expected to be 17%. So if I summarize the above data, but before I go into the summarizing, you have to understand कि ये जो हमारे अलग अलग डिविडेंड्स के और प्राइस आफ्टर 1 ईयर के एक्सपेक्टेशंस हैं, ये बिकॉज ऑफ डिफरेंट वैल्यूएशन टेक्निक्स हो सकते हैं, डिफरेंट मार्केट परसेप्शंस हो सकते हैं. एज यू सी एनी फाइनेंशियल चैनल, they will you will find that various brokerage firms or the consultancy firms rate a particular share to either go up or go down. Some will say it will go down, some will say it will go up, some will say it will go very high up, some will say it will go very high down. There can be best scenarios, worst scenarios, mid scenarios, and in all these scenarios they have different perceptions about the company of their own, and they will also provide a probability data along with that if you study the reports in detail. So we are not questioning how these prices have been anticipated, but this could have been the various scenarios that could be systematic and unsystematic risk. That is, it may be due to a company specific data or generalized economic data. So not going into that details again. Now if I summarize this, so what I am getting, that we have a probability chance of 20%, that is 0.20, 10% that is 0.10, 25% that is 0.25, 15% that is 0.15, and 30% that is 0.30. And if you see the total, then this will generate 100% probability, that is 1. It means the returns are expected to be one of the 5, and the expected returns at 20 at sorry I should say start with the lower, the at 30% probability is 17%. I can write it as this way, or I can write it straightforward in percentage, that is it can be 17, so I just write it in percentage here. For 15% it will be a 20% probability. For 17.5% it is a 25% probability. For 10% it's a 14% probability, and in the first case it was a 44% probability. So if I multiply probability with the R, so this will come out to be 8.8, this will come out to be 1.4. So how it has come? 44 into 0.20, 14 into 0.10. This will come out to be 17.5 multiplied by 0.25. So it is coming out to be 4.375, that is 17.5 into 0.25. This will come out to be 3%, that is 20 multiplied by 0.15, and this will come out to be 5.1, that is 17 into 0.30, and if we add all of them, So this comes out to be 22.675 percentage. This is what you call the expected rate of return. What you call is expected rate of return, and we denote it by R bar. So what is happening here, that with a 20% probability you anticipated a return of 44%, but after covering all expected possibilities, the return could have been 22.675. So there is a difference between what you anticipate and what you are not anticipating, and we can ignore this minus sign because this denotes the difference. So if, irrespective of the fact whether it is possible, चलिए हम अभी इग्नोर प्लस माइनस को ना करें, एग्जैक्ट फिगर दिखाते हैं आपको, जस्ट टू शो दैट दिस इज नॉट इम्पॉर्टेंट, दैट यू आर एक्सपेक्टिंग अ डिक्लाइन ऑफ 21% फ्रॉम व्हाट यू एंटिसिपेटेड, and there is a 10% probability that you expected a return of 14%, but you are going to get a return of 22.675%. There is an increase of 8.675%. Similarly, there is a 20%, 25% probability that you anticipated 17.5%, but you are going to get 22.675. That is an increase of 5.175%. And there is a 15% probability that you anticipated 20% and you will get 22.675%. That is an increase of 2.675%. And there is a 30% probability that you anticipated 17% and you are going to get 22.675%, and there is an increase of 5.675%. So if you see here that because of this very high percentage return, though with low probability, is causing a positive shift towards the expected returns. So what you are planning on your own and what you are anticipated to get is increasing, is getting into positive figures because of this high return which is having a quite substantial probability. So this in a way reduces the risk of the security, and this reduction in the risk of the security may prompt the investors to go for the returns because there is quite a high possibility of getting more than you anticipated. And if it achieves this 20% probability returns, then it could be a multi-bagger investment option, it could be a return, it could be a stock which give you much more than what the market has anticipated as a whole. Therefore, this investment option can be analyzed on this basis of return or risk calculation. Another aspect of getting into this can be that now we will calculate the square of this, and this square of the two will nullify the impact of the negatives and the positives. So this square will become 21.325 multiplied by 21.325. So this comes out to be 454. In the second case, 8.675 multiplied by 8.675. This comes out to be 75.255. Similarly, 5.175. This comes out to be 26.781. 2.675 multiplied by 2.6755 gives a figure of 7.155, and this last figure will be 32.206. And if we multiply this square with the probability, so beginning with the last, this will come out to be 9.661. This will come out to be 1.073. Third one from the bottom will come out to be 6.695. This will come out to be 7.525, and this will come out to be 91.55. And if we have this total, so this total comes out to be 116.505. So basically, this is what? It is the summation of r minus r bar square multiplied by the probability. And if we put the word I here, so this I in r bar is not important because this is a single figure, and this I in this case may move from 1 to n, and this n in this case is 5 here. And if we do the under root of the total, then we arrive at the figure of standard deviation. So the standard deviation, which is a kind of absolute measure of risk, will in this case will be around a figure between 10 to 11. You can always use the scientific calculator to arrive at this figure, but this will be a figure of 10 to 11. And because of the fluctuation of returns from 14 to 44, though it may prompt an investor to go for it looking for a multi-bagger, but this is can be comparative comparison with other investment options. So what a portfolio manager does, that he identifies purchasable securities which he believes that should be purchased, and then he analyzes their expected dividends and the expected price during their period of investment horizon, and on the basis of that they also calculate their expected rate of return, which is again used to calculate and arrive at the figure of standard deviation. And this standard deviation is used to analyze the security for its purchasing intrinsic value, and it can be used also for portfolio selection, where covariance and correlations are also calculated, which measures how the return on one security changes in accordance with the other security. And these correlations, covariance, and standard deviations are used as statistical tools, or I should say, they are the statistical tools to do the perfect portfolio selection. And on this note, myself Deepak Gupta close this session on risk and return